There's just a lot of things pointing towards higher gold prices going forward. And, in the short run, of course, we've got seasonality right now. And usually January and frequently February are good months for gold. Central banks are suddenly aggressive buyers of gold, and they've got you wouldn't even call them deep pockets. They've got basically unlimited pockets because they can create as much new currency as they want to and just use that to buy gold. So they're shifting out of, in a lot of cases, out of dollars and into gold with their foreign exchange reserves, their monetary reserves. And they're doing this in part because the dollar is not trustworthy anymore. The U.S. is using it as a weapon.
JohnRubino is a prominent voice in the domain of precious metals. In this video, JohnRubino highlights the historical trend of gold performing well in January and February due to seasonality. Gold has certainly been on the move throughout 2023, rising around 15% from the start of the year until May, then dropping 13% into October before rising nearly 19% to print an all-time high at the beginning of December. Several factors influencing gold's price are pulling in the same direction ahead of first quarter of 2024. Rubino notes a strong tailwind for gold prices driven by central banks aggressively buying gold, expecting a significant shift with around 1,000 tons purchase in 2023. This trend is linked to concerns about the reliability of the dollar. Central banks have been a major source of demand in the global gold market over the last couple of years, and 2023 is likely to be a record year. The WGC expects this to continue in 2024. Meanwhile, Rubino further predicts a potential market impact due to major retailers such as Costco and Walmart entering the precious metals space. Costco's and Walmart's gold rush comes as gold prices have soared 14% since early October to a new record high of $2,088 this week. Gold's strength has been underpinned by traders' aggressive Federal Reserve rate cuts pricing. JohnRubino is optimistic about 2024 for precious metals, foreseeing a potentially interesting year. He suggests silver could hit $50 to $100 based on current trends. Silver, ex-ag, might reach an all-time high of $50 per ounce in the next 5 years if the market conditions improve as expected, according to the latest silver price predictions and forecasts published by online AI-based forecasting agencies. Now, we present the clips of JohnRubino's insights from his recent video from Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Yeah, you just named 4 or 5 things that all constitute individually tailwinds for gold. In other words, they're good, other things being equal, and they would give you higher prices unless something else happened that was more important. But you put them all together and you get a very strong tailwind. There's just a lot of things pointing towards higher gold prices going forward. And, in the short run, of course, we've got seasonality right now. And usually January and frequently February are good months for gold for reasons that, your guests have covered a bunch of times on your show. But beyond that, like you said, central banks are suddenly aggressive buyers of gold, and they've got, you wouldn't even call them deep pockets. They've got basically unlimited pockets because they can create as much new currency as they want to and just use that to buy gold. So they're shifting out of, in a lot of cases, out of dollars and into gold with their foreign exchange reserves, their monetary reserves. And they're doing this in part because the dollar is not trustworthy anymore. The U.S. is using it as a weapon. So by loading up on, say, treasury bonds at your central bank, you're kind of choosing sides in the world. And a lot of countries don't want to choose sides in that way. And gold is neutral. So you're not making a political statement necessarily when you put gold in your central bank's reserves. So that's happening. And it's happening on a big scale. It's something like 1,000 tons of gold will have been bought after we're done doing the accounting in 2023. That's a huge number in context of a, 3,000 to 4,000 ton annual production market. Costco and Walmart starting to sell precious metals. That's also a potentially big deal because Costco started it, and they found that they sold out of gold bars within hours after they listed them online, which means there's a lot of pent-up demand there, and it's kind of impulse buying demand. In other words, you didn't necessarily go on Costco.com with the intention of buying a gold bar, but you saw it there and thought, well, why don't I add that to my shopping list? And so now Walmart is doing the same thing. with a much bigger selection. If you look at their precious metals page, they've got a lot to offer, including silver. So basically, precious metals are becoming an impulse buy. And there's a ton of pent up investable cash out there right now, something like 0.8% of global investable capital is in precious metals right now. So let that just go to 2%, which is still historically a low number for precious metals exposure. And you more than double the demand for precious metals. And that's a market that can't handle that kind of an increase in demand. You would see silver in particular just go straight up like it does every 20 or 30 years. So we could see easily, $50 to $100 silver just based on these kinds of trends. So 2024 is looking like an interesting year for precious metals. There are macro reasons to be worried in the short run, in other words, the first 6 months of the year. But I think a lot of things are coming together to make precious metals a lot more in demand and a lot more interesting and a lot more lucrative of an investment than they have been lately.
JohnRubino points out that gold tends to rise when the Fed stops raising rates, anticipating future easy money, while equities usually dip until the Fed makes substantial rate cuts. Gold prices surged on market expectations of the Federal Reserve's early cut in the U.S. interest rate in the first quarter of 2024. The surge in gold prices was prompted by a significant decline in the U.S. Core Personal Consumption Expenditure Price Index in November, reinforcing hopes of imminent rate cuts by the Fed. Furthermore, Rubino expresses his belief that the anticipation of a looming recession and the political pressure of an election year influences the Fed's stance. He sees 2024 as an inflection year when people recognize the issues of excessive debt, money creation, and government spending, prompting a change in financial strategies. Since 2019, the total national debt has increased by 25%, but interest paid on the debt has increased by 75%. More specifically, interest on the debt came in at nearly $573 billion in 2019, but it will top $1 trillion in 2024. Let's get back to the interview.
But yeah, historically, gold starts to go up when the Fed stops raising interest rates. Whereas equities, for instance, go down for a while until the Fed cuts interest rates dramatically. But gold starts to go up sooner because, it anticipates easy money in the future and people start buying ahead of time. And that's where we are right now. The Fed has kind of sort of promised not to raise interest rates anymore, and they're talking about cutting interest rates several times in 2024. The reason for that is twofold. One is that they see a recession coming, like we'll talk about in a minute. I'll tell you why they see that. And it's an election year, so probably they got a phone call from the White House saying, if you guys ever want any part of any future political system, you're not going to be raising interest rates right up to a presidential election where we need to be reelected. So the Fed feels that pressure, and more than likely they'll respond to it by cutting interest rates, maybe more than people expect right now, because 1 or 2 quarter% cuts in the year ahead won't do a thing to revive the economy. So they're going to realize that and start panic cutting at some point. Well, that's, at some point that becomes good for equities again. It's not yet, but that's very good for gold and silver. So we could see a kind of a 2009, 2010 environment where precious metals, maybe they go down temporarily with equities, but then they just take off once it becomes clear that easy money is basically here. And this time around, we've got kind of a unique monetary policy environment in which cutting interest rates is going to say to the world that interest rates can never again go up to these levels, because we saw what happened. Government interest costs just went parabolic, just spiked from several $100 billion a year to $1 trillion a year. Personal interest costs of what individuals have to pay on their debts did the same thing. It went from $200 or $300 billion a year to $600 billion a year straight up. It didn't even take a year in order to cover that ground, and it'll only go up as long as interest rates stay at this level, which means consumers will be more and more impoverished, less and less able to spend to drive the economy going forward. And that's what we're looking at. We've got these big imbalances out there, tracing from excessive debt colliding with higher interest rates that have to be changed. Those things have to be worked off in a dramatic way. And I frankly don't see any way to do it. I think this is very possibly the time when people figure out that extremely easy money is basically the new normal forever, regardless of what that does to inflation. And then people think back to 2022 and what it was like to have prices go up by 10% in a single year, and they're going to act accordingly. You'll see hoarding, and you'll see aggressive moves into real assets and out of financial assets. So I think this is one for the history books here, and it's going to be fascinating to watch because it's the culmination of so many long-term mega trends, basically, in terms of debt and money creation and government spending. So you take all those things, put them together, and 2024 is maybe going to be the inflection year when people figure out that that doesn't work and start looking around for what's next.
According to Bhavik Patel, senior commodities analyst at TradeBull Securities, as 2024 will be a year of easing monetary policy, gold prices are set for fresh lifetime highs, both in COMEX and the domestic MCX. What insights do you have about the evolving trends in precious metals for the upcoming year? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.